Hey guys, I'll be looking to cover a series of option strategies, starting with the covered call strategy. I will highlight the rationale behind such a structure, how to structure it, followed by a series of scenario analysis. Following this, I will also look to incorporate certain live videos on actual trades using this strategy so that you will have a better sense of the actual implementation and my thought process in the various scenarios. Okay, so the covered call strategy is also what I term as the landlord strategy, because just like owning a property to generate monthly rental income out of this asset, you can also do the same thing with your stocks. A huge benefit associated with trading options that you guys are now entitled to. So without further ado, let me delve into the meat of this strategy. Let's look at the rationale of engaging a covered call strategy. First, you are bullish on an underlying counter. That's why you wish to buy the stocks in the very first place. However, instead of just waiting for the share price to appreciate, you can now generate some rental income out of your stock holding through this strategy. So this is one strategy where you engage when you are long-term bullish on the counter, but you also notice that on a short-term basis, there could be some technical factors in place that could be a headwind to the counter. Hence, instead of just waiting, you make the best use of this situation by generating some income. This is also one strategy that is ideal for dividend-paying stocks. You get to keep the dividend from the stock ownerships and you get to generate additional income from your option structure. So how does one structure it? First, you need to own at least 100 shares of the underlying. After you own 100 shares of that underlying, you can then proceed to sell a short-term call option, say around 30 to 45 days of expiration, slightly above the key resistance level that you have identified. Now, as a seller of a call option, you are entitled to receive a premium, which is like your short-term rental income. Note that you can look to execute the purchase of your 100 shares and the sale of a short-term call option independently. It does not require you to be executed together at the same time. My preferred method is always to first purchase the underlying shares, wait for the price to rise, then sell a short-term call option to further enhance my profitability. Now, when it comes to the risk side, it is similar to owning a stock, and your downside risk can be substantial if the price of the underlying drops significantly. So this is not meant to be a hedge strategy. The other risks associated with this strategy is the potential premature exit of your underlying shares. I'll talk more about it later on. Moving on to the payoff diagram, as you can see, the risk can be substantial if the price of the underlying declines significantly. Your profit potential could also be capped at the sell call strike as a result of the premature exit in your shares. Let me illustrate this concept with a few scenarios. Now, let's assume you like the fundamentals of stock ABC and wish to hold the stock long term. ABC is also paying a nice dividend of 4%, hence it might make sense to own the shares. You bought 100 shares at a cost of $100 per share. After buying the shares, you notice that there might be some short-term resistance at the $115 level. Hence, you decided to sell a call option at the $115 level. As mentioned, the cost of your shares purchase is $10,000. The income collected as a seller of this 30 days call option is $100. Your overall net cost is thus $9,900. Now, what happens when the price of ABC appreciates to $114 after 30 days when your call option expires? This is actually the most ideal scenario. Since the price of the underlying is below your sell call strike of $115, your call option thus expires worthless. As the seller, this is music to your ears. Your profit is the full $100 income you received earlier. You also get to generate unrealized profit from your stock ownership such that your profit is now at $1,005. Now, this is not the end of the story. Since your call option has expired, you are now entitled to sell another round of call option, this time increasing your strike price to the next identified resistance level. In this way, you continue to benefit from your stock ownership while yet continue to generate a consistent flow of short-term income from your sell call option. When done well, this can be a cycle that you can keep on repeating. Now, in scenario 2, the underlying price appreciates to $116, which is now above your sell call strike of $115. If no action is taken, your existing shares will be sold at $115, which is your sell call strike, and not at the higher $116, which is the current market price. So do take note of this point. You will close this transaction and realize your full profit potential of $1,600. However, if you wish to continue holding onto your stocks, then what can you do? You can basically roll your call options 2 to 3 days before it expires. This will avoid the sale of your stock. What you can do now is to roll your sell call up and out. Now, what do I mean by that? When you roll your strike price up, you're shifting your strike price from the original level of $115 to say a higher strike price of $120. This is advantageous because the 100 shares you own now has got an additional $5 appreciation potential instead of being capped at the original $115 level. You rolled it out to extend the contract duration for another 30 to 45 days. Now, when making this roll, do make sure that you continue to receive an income from it, meaning that you generate a net credit out of this roll. If this roll requires an outlay, then let's take a look at this scenario where the price ends at $120, which is quite a bit higher than your original strike price of $115. Now, you still wish to hold onto your stock and hence decide to continue rolling your sell call. However, this time round, you are not able to shift the strike price higher to increase your underlying share profits potential. You can only roll it out to a further horizon. And in doing so, generate an income from it. If you wish to increase the strike price to $120, it might result in an overall net debit or payment on your part, which is not very ideal unless you are super confident of the appreciation potential of the underlying stock ahead. This brings us to scenario 3, where ABC appreciates significantly to $125 during this period. Now, the act of rolling the call option will no longer generate any more significant income for you, and the better course of action is to exit this trade where no action is required on your part. On the contract expiration, you will be forced to sell your shares at a strike price of $115, not the market price of $125. Hence, this is considered a premature exit, one of the risks highlighted earlier. Nonetheless, this is still very much a profitable trade for you. Now, if the price of ABC declines to $95, what is happening here? Your sell call will expire worthless. You get to keep the full $100 premium, and as such, have also lowered your cost from the original $10,000 to $9,900. However, your stock ownership is now only worth $9,500, hence you have an unrealized loss of $400. What you can do as a loss mitigation strategy is to sell a short-term call option at your cost price of $100 to generate the next round of income, say $150, to help offset your existing $400 losses. This will further reduce your break-even level to $97.50, and you can continue this cycle over and over again. So in a nutshell, as can be seen, a covered call strategy is one of the easiest and best way to further enhance your return potential of an underlying stock. Even when your stock is not appreciating in the short term, you can still get to benefit from the short-term income potential of this strategy. As the direct owner of the stock, you also get to keep the dividends that you are entitled to. Hence, this strategy is more ideal for a dividend-paying stock. Lastly, this can also be used as a loss mitigation strategy, as I have highlighted in scenario 4. On the risk side, this strategy will not fully protect you from a decline in the price of the underlying. The premiums generated from the sell call can, however, be used to partially offset the unrealized losses from your share ownership. The second risk is that if the price appreciates too quickly, you will no longer be able to execute a rolling strategy effectively and might be forced to exit your shares at the strike price of your sell call. I hope that this short video has been useful in your understanding of the covered call strategy and the various scenarios that you might encounter. I will follow up with live video examples on trades that I've done using this strategy. See you guys.